If there's one thing I've learned over the years as an income investor, is that it is challenging to locate robust, high dividend paying stocks. Stock investing isn't always straightforward. It is true that there are lots of stocks out there with large dividend yields, many of which are above 10%. But if you look into the performance of these firms, you will find out that they have a history of persistent share price depreciation as well as a number of dividend cutbacks over time. But before we continue, if this is your first time here at the Smart Stocks Academy channel, let me give you my warmest greetings. And to be the first to know when a new video is released, don't forget to hit the like button, subscribe, and hit the notification bell. So if you're ready, let's get to the video. You'll definitely come across a number of energy businesses while looking for high dividend paying stocks. These are companies that pay out extremely large dividends. As long as energy prices are particularly good, companies like royalty trusts and master limited partnerships can pay dividend yields of 15% or more, depending on energy prices during a given period. However, if you look at their past dividend payouts, you will notice that they have a large fluctuation in their dividend amounts. As a result, many of these firms are not worth keeping for more than 10 or 20 years. Yes, there will be times it yields 15%, but then it could yield 1 or 2% in a couple of years. And on top of that, these businesses can have some problematic tax circumstances. Finally, there are a lot of mortgage-rich and business development firm stocks that offer dividend yields of roughly 7 or 8%, or perhaps a little higher, but essentially no growth over time. Now, I do like a lot of these stocks because of their continuous high income, but every dividend portfolio should have at least a little amount of growth. The Gallup Capital GBDC is one example of this type of stock. Currently, it offers a 7.72% dividend yield, which is rather attractive. But when looking at the stock's long-term performance, the share price has been nearly unchanged over the years. According to Yahoo Finance, it was initially trading between 14 and 20 cents per share, but currently it trades between 15 and 50 cents per share some 12 years later. And if you look at this company's dividend history, you will notice that the dividend payments to shareholders have stayed quite consistent over the last decade. But now, I would want to focus on one dividend stock in particular, which I believe has been trending in a positive way, and about which I have never seen anyone else talk about. It presently has a tremendous dividend yield of over 12%, which has been increasing over the last few years. Its financials have lately improved significantly, including both book value and net income. It also has a high insider ownership percentage, which is another indicator I like to look at, because strong insider ownership usually suggests that the company is well run. The stock I'm talking about is for a firm called Ready Capital Corporation, which works as a real estate financing company in the United States. It originates, finances, and services small business commercial loans and small business administration loans. They also engage in mortgage-backed securities, which are often secured by SBC loans and residential mortgage loans, as well as bridge financing, which is a service provided by Arbor Realty Trust. Ready Capital has a dividend yield of 12.10% as of the filming of this video. This translates to a quarterly dividend of 42 cents per share. As you can see, the dividend was lowered in late 2019, and again during the pandemic in 2020. But the good news is that the company has been doing well since then, not only in terms of their income, but also in terms of their dividend amount, which is now not only equal to what it was before the epidemic, but it has actually climbed by 2 cents, making it their biggest distribution since 2013. Mortgage REITs are organizations that finance income-producing real estate assets across a wide range of sectors. REITs are an excellent investment. However, not all REITs, particularly mortgage REITs, are suitable investments. The business structure of Ready Capital sets them apart from most mortgage REITs, notwithstanding the fact that they had to temporarily lower their dividends. According to this article, Ready Capital mortgage portfolio fared so well during the first wave of the pandemic that they suffered no losses. Ready Capital has been on a merger and acquisition spree, acquiring several other companies in the media and finance sectors in the last couple of years. Ready Capital successfully merged with another mortgage REIT, Anworth Mortgage Asset Corporation, 10 months ago. Anworth had been suffering after incurring a $64 million loss in 2019, and they lowered its dividend payout amount from 25 cents to barely 5 cents per share. The combination resulted in a combined Ready Capital basis of more than $1 billion. Ready Capital, a well-diversified investment portfolio, has been stretching its muscles by acquiring or merging with other firms in order to expand their business further in the third quarter of 2021. They have recently merged with Mosaic Real Estate Investors, which will definitely expand their reach and diversification. They also recently purchased Redstone 3 months prior, giving Ready Capital additional diversification inside the multifamily real estate market. And as you can see, they also acquired Anworth Knight Capital Funding, Owens, and ZFC. All of these mergers and acquisitions have resulted in a lot more diversification, which is excellent for a mortgage because it reduces risk. SBA originations, acquisitions, and servicing account for 34% of their portfolio, followed by 31% in SBC bridge originations, 14% in SBC fixed rate originations, and so on. When compared to other mortgage REITs, I believe that Ready Capital is becoming one of the finest in terms of diversity, thanks to all of these mergers and acquisitions with other firms. One of the recent investor presentation includes a graph that indicates how much better they have been performing than their competition. You could be wondering about why most mortgage REITs invest in or issue residential or commercial mortgage-backed securities rather than SBA or SBC loans, just as Ready Capital does. So, what are the benefits of investing in a mortgage rate that includes SBA or SBC loans? For starters, these loans that Ready Capital maintains are backed by the United States government full faith and credit guarantee, as well as regular payments. Another significant advantage is that these loans have a variable rate characteristic. According to the website of Ready Capital, these loans have long maturities ranging from 5 to 25 years to suit any criteria the small firm may have. Depending on the firm, Ready Capital offers loans ranging from $350,000 to $5 million. Now, to go into detail on SBA and SBC loans would take a long time. But if you want to learn more about what they are and how they work, you can go to sba.gov. From there, you can find out how small businesses apply for these types of loans, as well as how companies like Ready Capital select which businesses they give money to. With all of the recent discussion of rising interest rates, Ready Capital is in an even better position, as their loans are made up of 70% variable rate loans according to their financials. As interest rates rise, Ready Capital will be able to generate more money from their loan portfolio. When interest rates rise, there are hazards for both merchants and business development firms. However, some companies that engage in variable rate loans earn more money. It may also imply that more borrowers may fail on their loans. Therefore, interest rates for both of these types of firms must be tread carefully. While researching this stock, I did want to look at one specific number that I generally like to mention for a lot of firms I analyze, and that is their insider ownership percentage. However, in the instance of this firm, I was a little doubtful about the percentage that Fintel.io was offering. This is a website that I use to determine stocks insiders' ownership percentage, which indicates how much confidence the firm's board of directors has in their own company. And according to Fintel, this firm has an insider ownership rate of 17.93%, which seems a little too high for me. So I decided to cross-check the statistic on another website called Guru Focus, and according to them, the insider ownership ratio is only 1.3%. You may calculate this manually by dividing the total number of shares held by insiders by the total number of shares outstanding for a stock. But most websites that give the number of shares owned by insiders will also supply this measure, so you don't have to do that. Let's have an example like Orchid Island insider ownership percentage. Fintel was giving me a percentage of 0.36, and on Guru Focus it was giving Orchid Island a percentage of 0.31, which is close to Fintel's. So for Ready Capital, I don't know why it says 17.93%. That is not the correct level of insider ownership in my own opinion. So, I am wondering if all of the recent mergers and acquisitions have thrown off the statistic on Fintel. But at 1.3%, this is greater than other equities I have seen. As I previously mentioned, a high insider ownership percentage is a solid indicator of how confident the board of directors is in the future of their own firm. If a stock has a very low insider ownership percentage, such as Orchid, and especially if it is a dividend stock, it indicates that even the individuals at the top of the firm does not want to hold on their own shares. It is possible that the board feels the firm is in crisis, or that they won't be able to maintain their dividends. But it also relies on how many shares are issued for a company, as well as the amount of corporate insiders. That being said, in the case of Ready Money, I believe 1.3% is a good amount and more than usual based on what I have seen. In conclusion, I believe that Ready Capital is not only a sound investment, but that as long as COVID does not severely interfere with the economy, I would not be shocked if this firm boosts its dividend anytime this year. With rising interest rates, I believe this might really assist to put the organization up for success in terms of net income. And even if they do not raise the dividend anytime soon, a 12% yield is still an excellent opportunity. Having said that, I believe that Ready Capital is worth considering for anyone searching for a strong yield. It does not appear that the stock market as a whole has recovered from its volatility, so we'll still have to wait and watch how their share prices fares in the future. Before anything else, be sure to conduct your own research and due diligence before reaching your own conclusions. And don't forget to adequately diversify your portfolio to limit your risk exposure. And with that, today's video comes to a close. If you haven't already, show your love and support for this video by hitting the like button, subscribing, and turning on the notification bell next to it to be the first to know when a new video is released. I hope you had a wonderful time, and I hope to see you again on our next video.